Susan, are you in the house? There you are. Come on up. So many of you know Susan Preston. Is it managing director the right term?
Managing member, managing director,
Yeah.
whatever you want.
Head honcho. So Susan wants to chat briefly about the HALO report, the Seattle Angel Fund. Nobody better to do that than you.
I'm also the chair of the Angel Resource Institute, which was spun out of Kauffman Foundation 10 years ago. And we are a 501c3 dedicated to the advancement of angel investing through research and education. And so our HALO report is very unique from the standpoint, it is the only report that provides us with information regarding tracking the trends in angel investing. So specifically looking at things like valuation, the percentage of deals by region throughout the United States, and also looking at various aspects of where investors are putting their money. One of the important things to remember is that we are here, we may not be the largest populace in the United States, but we are fairly active here. But we're still lagging behind where we should be from a percentage basis. So if you look at the entire United States, we are about 4.5% of the deals out there on an annual basis when we looked at all of 2015. We are more than that of the population, so there are great opportunities for us to invest in more companies in doing that. One of the other statistics that I was going to show you is where valuations were, where they are or were in 2015, and where we're predicting they will be on average for 2016. And right now, we're seeing the valuations are going up a little bit, but staying consistent with where we pegged them in 2015, which is at 4.5 million on average. That's a national average. So that takes into consideration some bit of anomalies coming out of Silicon Valley, as well as out of the New York area. So what that means for us here is what we've been seeing on a typical basis, at least in 2015, the values here in valuation on average were more around 3.8 million. But we are still seeing some trending that way, and we are seeing some interest of being a little bit more advanced on the valuations. This is always in nature of whose market it is. Is this an investor market or is this an entrepreneurial market? And so it'll always make a difference as to which side of that coin we're looking at. One of the other things that we had the great benefit of being able to do this year is we did another return study. We haven't had a chance to do one for 9 years in the United States, but thankfully ARI, we received a nice size grant from both Kauffman Foundation as well as NASDAQ. And we looked and had assessment of what is the return multiple for angel investors in this sector, in this particular asset class. And we've seen that on an average across the nation, when we did our assessment recently, it's about 2.5 times. So ROI is about 2.5x for angel investors, and that's in about a 3.5 to 4 year time frame of doing that. That's slightly down from the prior study, but it's still very respectable. And in fact, Josh Learned from MIT recently put out a paper. It was really interesting is that there was a much higher number of companies that were 1 times return or less. In other words, they didn't really return any money to the investors. But where we saw a pop and an increase was in the companies that returned 5 to 10, 15 to 30x, this higher range of return opportunity. And those actually were higher than the prior time frame. So interesting, and you try to understand what may be going on that is causing this interesting change in return. And it may be partly that a study we've done now in 2016 has taken in the recession times. So a lot of companies were not able to make it through the recession and they died. But the ones that were able to ride that storm all the way through really came through strong. So I'm hoping that we'll be able to do the return study on a little bit more frequent basis, possibly every 3 to 4 years, but it will just depend on our ability to get grants from these organizations. And then the other thing that I just wanted to tell you about is that it's really nice to be here representing Seattle Angel Fund. My partner Will Finney is in the back. And we are delighted to see some of these companies come through. We're sort of the next phase up. And we are interested in hearing from the companies and engaging with you to hear how it might be interesting for you to pitch to the Seattle Angel Fund as well. We look at companies a little bit more advanced, and the fund is a structure in which you are actually investing. We are investing as a single unit, much like you do for the SAC, but we do it for an entire year. So last year's, the first fund we did had 6 companies in it, so nice diversification of the portfolio. This year it may be a little bit different. We are still raising money. We are still bringing in investors through the end of this month, but we are already on good track. We've invested in 4 companies right now, and we'll be looking forward to doing more as we move through the remainder of Fund 2. The price of admission is each unit is $25,000, and these are annual funds, so we invest during that 1-year time frame. It's modeled after the Oregon Angel Fund, and then it does give you the opportunity. All the companies that come through, I can say that every single investment we've ever made through the fund, other members have made investments individually in those companies. So every single one of those companies has had a really great response in doing that. Other questions? Other questions about the statistics? Anything? Yes?
Are you seeing, with the valuation fluctuation, are you seeing fluctuations in ownership percentage as well? Or is that staying roughly the same and the rounds are just getting bigger?
The rounds are getting a little bit bigger. Some of the stats, it's hard for me to talk about it, but we did see an increase in the general round size in 2015 over prior years, both as when angels invested by themselves, as well as when we co-invested like with small venture funds. So in theory, you do see a correlation a lot of times that if the money is increased, so in other words, a company goes from raising $1 million and instead they decide to raise $2 million, we'll often see a slight increase in the valuation as well, because the company can accomplish more with that money, and therefore it can support a higher valuation. So there is some opportunity for less dilutive effect on the founding company or founding entrepreneurs of doing that. Does that make sense? Okay. Other questions? Yes. Hey, Brian.
What sort of time periods for exits are you looking at?
As quickly as humanly possible. The average that we're seeing is, it's still 4 to 5 years, but it's very technology market dependent. It's also highly dependent on whether VC round is required. We do see statistically companies that have to take VC money in, it adds up to 5 years on their exit. Yeah, I know. The reason why is that if a VC comes in and they don't plop down much less than 10 million at a time, most of the time much more than that, they are still having an expectation of the same multiple of return as we do, very high return multiple. Well, if you have a company that's received $40 million in investment money, getting to a 10x return means a whole lot more in revenue generation for that company. So it's far more mature than for us. If the company's only raised $4 million and we want a 10x, it's much easier for that company to sell it for 40, for instance, on a 10x return. And much more likely to have buyers out there for that smaller, and they don't need that time frame to get to those kind of revenues of doing it. So it's just the logic, actually when you start thinking about it, it makes a lot of sense. All right, so this is the statistics on the median and the mean round sizes, and you can see in 2015 it went up from 510 to 850 on the median and all the way up to 1.16 on the mean. So you can see the rounds did increase in size between those 2 years, and we're still seeing this same kind of trend. Next slide. And this is showing you just the size of the rounds when we co-invest, as I mentioned. A little bit larger rounds, of course, but still on an increase. Not as dramatic, but we're still seeing a little bit of an increase there. Next slide. And then when we look at just overall, When angels invest individually, of course it's going to be a smaller amount than when they invest as groups. But when we split up and looked at where the investment percentage was, this is for groups, this is not for individuals, this is for groups. The majority of them were investing between $250,000 and $500,000 in each round that they were active in. Next slide. I'll do this really quick. These are just some of the active angels. Alliance of Angels here in town was what they're. I'm just going to tell you that Seattle Angel Fund's going to be up there very shortly. And do that. Yay! Woohoo! Okay, and this is what I was talking about here. Now this is what's interesting, I think, because see, look at this. 2007, the blue line is what we did in the United States here 9 years ago. The red, the orange line, or excuse me, mustard, I guess, we did that in the UK in 2009. But the red one is the most recent one that we just did in 2016. As you can see, huge increase in the number of companies that were 1 or less. So either barely returning money or not returning anything to us. And yet, and then 1 to 5 was low, but when you get down here to the 5 to 10 and the 10 to 30, we actually saw an increase. And again, I really think that there's something to be said for these companies that came through the recession. It'll be really quite interesting to, if we have the opportunity to do this on an annual basis, to watch and track this. Unfortunately, we just don't have the resources to do that, but we're working on that to try to do that. Last slide. And I'll just show you on a percentage basis what this looks like. So here again, 4.5 years, 4 to 5 years hold 2.5x. It is the best return of all asset classes. There is no other asset class out there that returns this kind of investment. So that, I mean, I think that is a really compelling point. Now this is primarily angel groups. Also, I just want to let you know, most of the information that we get at the Angel Resource Institute is from groups. So I would say 90% of the reporting data that we have is from groups. So I think this does bode well. It does say a lot about what exactly you're doing here, which is working together and doing very, very thorough analytical due diligence, and it pays out. And we do have statistics also that show that the more diligence you do, the better the return, and then also the more engaged you are after the investment, the better your investment results in. So anyway, thank you so much, Guru, for finding those slides. I really appreciate it. And any final question? Yes?
What are you seeing as far as trends of number of companies and the quality of companies coming to Angel Investors in Seattle?
So I think that if you compared it to 10 years ago, there's definitely an improvement. It does fluctuate, and it does depend in part on the industries. But in general, we're finding more educated entrepreneurs that are aware of the realities of the situation, and so we don't get as many radicals, so to speak, in the process. So they're honing in and understanding what the expectations are from investors. Okay, thank you very much.
Thank you.